Well, hello Nervos land, Rodrigo Santiago here, and this is a very controversial video. Sorry guys, I've been thinking a lot about proof of stake networks, and this is my personal conclusion. It doesn't mean that I'm right? I could be very wrong, but I'm just here to expose some thinking. So yeah, after we've finished our video series about the blockchain killers, I was brainstorming some ideas, and meanwhile doing another group of slides, I just went into this thinking about proof of stake networks. So let's go for it. Are you prepared? Because I am. I am prepared to be hated by people. I'm prepared to correct myself later on. I'm prepared for everything. I'm just accepting my fate here. So, who am I? This is not financial advice, standard disclaimer. It's just for entertainment and just food for thought. You should verify what I'm saying here. I'm not saying that I'm right. It's just random thought. My name is Rodrigo Santiago. I am a Brazilian guy, an IT tech lead, and a CKB holder. So this channel is about Nervos investing, and Nervos as a proof of work protocol. I have to compare it with proof of stake because people always tell me, oh, Nervos is not moving so much and everything. Well, it doesn't mean anything really, but let's just get our feet wet on this subject. So I encourage you to just correct me at any point. If you know that I'm talking some bullshit, you just shoot in the comments or just look in the Nervos community channel in Telegram. And also forgive me for any English mistake, written or spoken, because English is not my native language, so I try my best to communicate some ideas here, right? So let's go. Proof of work versus proof of stake. Which one is a better investment? It all comes to this, right? It all comes to this question. And when we are going through blockchains and cryptocurrencies, we'll always listen to that phrase, proof of work will benefit greedy miners that hate the environment. And this is also known as Satoshi was wrong when he chose proof of work as a consensus protocol for Bitcoin. So this is pretty much what many people think today, that greedy miners are stealing everybody's Bitcoin and something has to happen to get the power back to the common guys, the common gals and everything. So let's investigate it. We'll always stumble upon some news like this. Bitcoin consumes more electricity than Argentina, and this is kind of freak us out, right? But then when we actually see Argentina GDP in 2019, it was $444 billion, the annual GDP for Argentina. And Bitcoin today, it holds like 1 trillion in dollar value. So, well, if we have a country that's spending that much energy and we have a network that has more than double that amount of value and it uses kind of the same energy amount, it's not so bad, although I don't think that Bitcoin and Argentina economy are comparable things, because these are very different in nature. I don't want to play the insensitive guy that's telling that screw Argentina people, let's go for Bitcoin and whatever. It's not about that. It's just to have a a starting comparison. So yeah, Bitcoin spends a lot of energy, but it spends energy in the attempt to create a secure vault for value. And if Argentina people want to protect themselves from the Argentina peso's inflation, which is just huge, it's humongous, they can rely on Bitcoin network to protect their money, their value, right? So yeah, there are many Bitcoin holders in Argentina, and I guess they're pretty happy with the fact that they can store value in the Bitcoin network. So Bitcoin today is protecting assets from people all around the world which are living under reckless government policies on capital, on fiat money. So when we see things like that, people just being able to store value, to quit being victimized by bad government policies, well, it's amazing to have that store of value, but this is just the start, right? This is just the start. In order to compare proof of work with proof of stake, let's see how proof of work happens, because people will always complain about the amount of electricity that Bitcoin spends and everything. So, and they are arguing that proof of stake is the good side of crypto. Let's see. Let's have some sort of reflection here. So first of all, let's see how proof of work happens, right? So proof of work happens when, let's take Bitcoin network for example. People are exchanging value, buying Bitcoin, storing it as a value storage network, and nobody can take it down and all of that thing. And then in order for people to be able to exchange value in Bitcoin's network, we gotta have an investor that comes to the Bitcoin network, and this guy will buy some mining hardware and install some software in it, which is the Bitcoin node software. It will that person will rent or gather some installation, some specific specialized installation for that mining hardware and software, and a big chunk of electricity to start providing validation to the Bitcoin network. And because of that, he can start solving math challenges. So this is what Bitcoin is about. It's a network in which the miners, those investors, they gather all those resources, mining hardware, installations, and electricity, and they start like competing against each other to solve math challenges. And when any one of them solves one math challenge, he can actually earn some Bitcoin in exchange for providing the validation for the transactions on the Bitcoin network. So this is how it goes, right? So as miners are earning money, earning Bitcoin in exchange for providing validation on the network, more users will come to actually invest in Bitcoin mining. So this is all there is about the Bitcoin network. Then as more miners come, they will spend more money on mining hardware and software and electricity, and they will start competing, and there's more miners competing against each other to solve those even harder math challenges as time goes by, and more miners will be happy because they will earn more Bitcoin. So more validation will be provided, and then the Bitcoin network can grow both in user base, user count, wallet number count, and they can also grow in miners count and in overall Bitcoin's value, because The more people are holding Bitcoin, the more scarce it is, the higher the value of the digital Bitcoin is, and the more miners will come to compete against each other. So the overall price rises, and also the overall security of the network will rise accordingly to the Bitcoin's price. Because the higher is the price, the more miners start to desire to get into the competition. That math competition is probably the world's biggest math competition there has ever existed in the planet in human history. But all this wall of algorithmic math challenges is what makes Bitcoin unique and actually very secure. We have no event in which Bitcoin network itself was hacked, and yeah, there's no double spending on that network. So each Bitcoin can only be used once in a wallet. So it cannot be double spent. You can't use the same Bitcoin to pay two people at the same time. So sorry. So this is an image from what a specialized installation looks like for Bitcoin network. So, and any proof of work network will look like that. So very specialized, many different ASICs, all of them trying to solve math challenges. And if one of them can solve a certain math challenge before the other ones, that node instance will get a certain amount of Bitcoin. I think for each block that is created, the miners, the owner of that machine, will earn, I think it's 12 Bitcoins or something like that currently. And each 4 years, the reward is cut in half. So this is the Bitcoin's design. So proof of work, as we have that competition for solving those math challenges, the proof of work consensus protocol creates a high pressure for cheaper installations, faster mining hardware, and low-cost electricity, because the guy, the gal who can come with the best combination of those three resources, the most efficient combination of those three resources, he or she will have more winning machines. So it will be the biggest winner, right? So in order to have cheaper installations, they all look for developing countries, because labor cost is just too low compared to US and the developed countries, the most rich countries, right? So they are looking for placing their installations on developing countries, and they are also spending lots of money in research and development of those mining hardware and mining strategies. And they are also looking for cheap, efficient, and clean renewable energy sources. So it's not possible for a miner to be installed like in New York City, right? Or Sao Paulo here in Brazil. It's just out of question. The biggest cities in the world, London, Tokyo, it's impossible. It's probably impossible to have a mining facility on those cities, because the energy cost is too high in those places. So they go to places in which there's really nobody. Just those most faraway cities with lots of renewable energy, and in which the land is cheap. So they are going for those kinds of places, and they are bringing huge money to develop those places. So, and this is an article from CoinDesk. I'm going to read a little. Oil and gas miners team with Canadian tech firm for green Bitcoin mining. This is an enormous trend that's going on right now. So 35% to 76% of Bitcoin energy appetite is fed by renewables. Let's take the middle. 50% of the Bitcoin energy is fed by renewables. So it doesn't matter the amount of energy if it is renewable, right? And if it's clean energy, it doesn't matter really. Well, if we look, if you hate a big energy from being spent, you should probably hate the sun itself, because it's one of the biggest sources of energy in our planet. And you should always hate waterfalls, because all those water with huge energy going down, those huge amounts of energy shouldn't be there. So you should, if you hate a big quantity of energy being spent, or even spared, like wasted, you should hate the sun, you should hate waterfalls, rivers. You should also hate the wind, because it's too much energy going on. Wind, solar power, and waterfalls, rivers, water currents. Those are all those are nasty sources of energy. So it's not about. I'm just kidding here, obviously, because it doesn't matter how much energy is being spent. We are wasting lots of energy in our planet that's clean. So what we are having here in Bitcoin is just a big run for clean energy sources. And in order to do that, they have to go to developing countries, and they have to research. They have to spend lots of money researching, and they've got to find ways to create breakthroughs on energy generation, right? So this is what Bitcoin is about. It's about clean energy. It's about renewables. It's about creating a big breakthrough on energy generation development. So here's another one from CoinDesk, the last word on Bitcoin energy consumption. China is the epicenter of Bitcoin mining, with specific regions like Xinjiang, Sichuan, and Inner Mongolia dominating. So we got another part here. Sichuan, second only in the hash power rankings to Xinjiang, is a province characterized by a massive overbuild of hydroelectric power in the last decade. So overbuild, they've built much more than they need. Sichuan's installed hydro capacity is double what its power grid can support. So the city is consuming like half of what they are producing, leading to lots of curtailment or waste. They were wasting half of their generated energy, and it's hydroelectric power. It's clean, renewable. It will be there mostly forever. So otherwise, wasted energy has been put to use in Bitcoin mining. If your local energy cost is efficiently zero, but you cannot sell your energy anywhere, so this is the hydroelectric generators situation. They are generating energy for free. They are not selling it, and then here comes the miners and start buying it. So it's new business being generated, new development, new economic development being generated on those places in which there's quite abundant electric energy. So the existence of a global buyer for energy is a godsend. So those people are actually thanking for the Bitcoin miners to come in and start to develop businesses, because when a big miner comes in, he will hire people, he will develop new business around that mining facility. Even if it's a small mining facility, we could have new restaurants coming in, and all those kinds of business development around a business that what it wasn't supposed to be there, right? Those miners were right in the US looking for places to buy cheap energy, or they were maybe in Hong Kong or maybe in Shanghai, just thinking, what are the most like places there aren't many people around, and lots of energy sources, clean renewables, so that we can run our facility. So this is what Bitcoin and proof of work in general is about. And Nervos network is a proof of work coin. It's a proof of work protocol that improves on Bitcoin's Nakamoto's consensus protocol. So I'm not going to detail the technical details on why the Nervos blockchain has a better consensus protocol than Bitcoin's. Let's just establish a fact here. Proof of work is about clean energy, but it's not only this, right? So when we have miners competing against each other and looking for ways to buy cheaper and cheaper energy sources, what they are truly doing is they are spending money with development, with research, with education. So they are sending people back to the school and paying for them to discover one thing, one unique breakthrough that will take the other miners out of the game. So they are spending, all those miners are spending heavy money on research and development, both for faster computation power and for clean energy generation. They are also spending heavy money on developing countries, places like Africa, South America, Asia. Those places, they attract lots of miners because there are so many good spots for generating energy. So let me drink some water here. So this is what miner is about. And because it's about a clean energy, it's about research and development, and it is about a sustainable store of value. We are having a most sustainable world with those kinds of cryptocurrencies. So this is what Bitcoin and other proof of work consensus cryptos are about, right? So greedy miners, as people paint it, they don't exist at all. If you had that greedy miners image in your mind, just get rid of it. They don't exist as the hoarder of all the Bitcoins in the planet. They don't. They can use some strategies to get more and more Bitcoins on their wallets, but it's just the same strategies that other people or the other traders are using. Just several different strategies on that. But yeah, the best miners will be able to hold more coins on the long term, so they will be able to treasure more Bitcoins. So miners, they have huge costs because they are just competing against each other all the time, and there are lots of outflows of capital from the miners to society as a whole, to developing countries, research and development, clean energy, and and everything that we've talked about. So the miners who can keep business going are those who really do a good job of contributing. Sorry, they are the best miners will be the ones who contribute the most to the ecosystem and to the economy as a whole. It's not a guy that's holding those Bitcoins, not allowing anybody to have them. So yeah, it's not, right? So they have huge costs and they have to be very efficient. So all miners risk their capital a lot. And every miners know that every miner knows that it can be kicked out of the market if it doesn't do a very efficient job. So mining Bitcoin and other proof of work cryptocurrencies is more an industry than a hobby today. It's a big industry actually, and it is for the very specialized business people that knows about and have all those connections in the mining world. So they have to spend heavy capital because they have to be very efficient. Other than that, they will be kicked out of the game. So yeah, proof of work leads to a global flow of wealth distribution and sustainability. So while the holders are transacting on Bitcoin, for example, the greedy and competitive miners will have to spend those Bitcoins either with clean energy sources initiatives, they will have to hire people in developing countries, they will have to hire researchers for clean energy. And yes, to pay for all those costs, many of those Bitcoins are being sold in the market so they can keep some for their profit because it's a business, right? Nobody's doing charity here. So this is kind of how the crypto proof of work markets are gathered today. The money is flowing for many different hands and many different markets and many different countries. So imagine that the most rich people today are storing Bitcoins and their coins in, let's talk about Bitcoin because it's the biggest example today for proof of work consensus. So the most rich people today, they're storing Bitcoins and they're forcing money to be flown to developing countries and to clean energy and to research. So that's it. And it's all about that actually. Proof of work consensus is kind of an open system. So proof of let me get some final point here. So the proof of work consensus, it's an open system that requires that Bitcoin flows throughout the planet as a whole. It's just mandatory. You can't have a proof of work coin that allows for treasuring in the richest countries only. Miners have to go all around and deploy their money in all the most poor places in the world and the developing countries too. So this is kind for debunking the first biggest myth on proof of work. It is a lie that there are greedy miners that controls the market and everything. Yeah, we have some miners who are concentrating power and economics, but they have to be very efficient. And if you don't like that Bitcoin is getting kind of centralized, we have other cryptocurrencies coming in. So proof of work consensus is getting deployed to other networks. So we have competition and decentralization on the crypto space as a whole. So yeah, people are investing in new proof of work coins, such as Nervos, which is has so many improvements on top of what Bitcoin does wonderfully. So this is an example, a clean example for defending the proof of work protocol. So the next myth, the next thing that we hear a lot and read a lot in the space is that proof of stake is energy efficient and creates equality and wealth distribution. And the other, it's also called we are smarter than Satoshi. It's not only that Satoshi is wrong. Proof of stake guys, they are telling that we are smarter than Satoshi. Look, so let's see if it's really the true here, right? So it's my true actually. It's not the true. It's just some random thoughts in my head. This is no financial advice at all. And I'm actually looking for being corrected on those thoughts because they're keeping banging in my head all the time. So let's see how proof of stake happens. If you don't know, let's just get a clear picture of how proof of stake happens. So this is from Cardano. Ouroboros features mathematically verifiable security against attackers. The protocol is guaranteed to be secured as long as 51% of the stake, in the case of Cardano ADA, is held by honest participants, which in addition to other novel concepts is achieved through random leader selection. So they are alleging that Cardano protocol is very secure, but secure against what exactly? Let's see Ethereum that's going proof of stake right now. You can lose your money if you decide to try and cheat the system. So this is very important, right? Let me pause just to drink some water. Sorry. So you can lose your money if you decide to try and cheat the system. So they are affirming, they are stating that the network is protected against people who try to double spend, for example. So if any nodes that validates the transactions try to spend more than they should, if any wallet tries to do double spending or try to cheat the system, the network will penalize that validator, that wallet, whatever. So this is what it is. This is all there is about. So proof of stake is claimed to be attack resistant, since a staker could lose its money if it tries to cheat the system. Let's say that is true, because all those mathematicians and computer science researcher, they are very, very intelligent people, so they can really bring lots of innovation and create very sophisticated algorithms to protect the network from double spending, from network takeover and things like that. So proof of stake research focus basically on protecting from double spending without proof of work. So it's kind of an attempt to do a consensus protocol without using the energy, the higher costs of energy. So this is proof of stake. But even if the network is safe from double spending, my take on this is that there are other ways to cheat. Let's see them. Let's see how proof of stake happens. People are transacting, let's say ADA, for example, and some people, the investors, want to become validators. They are not miners, they are validators of ADA's blockchain. So what they do, they buy regular, very cheap servers for staking pools. They don't have to have any specialized installations, just regular ones for servers. And they have to get some money, some ADA, and they install those regular cheap servers with the Cardano's software for validation and staking pools, and they lock some of their crypto in those validation pools. So they kind of just handle money for the server, and the money is locked. And then when they lock some money into that software, those are crypto assets, right? What they do is they generate some validation, let's say, I like to see that as lottery tickets. So the more staked crypto, the higher the chances of being the validator and earning more crypto because of that. So this is how proof of stake happens. I handle my crypto to the staking pool, and the more money I handle, the more crypto I handle, the bigger is my lottery ticket. So when I contemplate it, I can earn some ADA in return for validating the transaction in the network. So people can keep exchanging ADA with one another. And then more people come to the network because ADA is awesome. And more validators decide to stake more crypto. So they buy regular cheap servers for staking pools. They get unspecialized installations, and they lock some more crypto in the software. It's no effort at all. So they keep stashing their money. And as they earn more VIP tickets to the moon, they get more and more ADA. And that money that's appearing here, it will also be staked in the future and it will not be spent. So validators, they can keep stacking their money. So more validation happens and the network grows, right? So this is standard for Cardano. This is the way that Ethereum is going to be. This is the same for Polkadot and all those most so-called modern cryptocurrencies. So proof of stake induces the following effects. First, don't have to spend special money on installations. Don't have to spend any extra money on specialized hardware at all. And the cost for electricity is pretty irrelevant. So it's not, the competition is not on that level, right? It's not at the same level as Bitcoins. What happens though is no tokens are spent for validating transactions. When you stake your coins, you don't have to spend them to earn more. So the biggest stakers, they earn a permanent right to validate future transactions at no cost. This is what happens. The biggest stakers in the network, they earn a permanent right. If somebody has, let's say, 5% of some cryptocurrency, some proof of stake cryptocurrency, they have the right to become the validators. It's weird from my point of view, because this leads to easy compounding interest and effortless is a key word here, effortless capital concentration. So people who have more will have even more in the future. So this is it. This is what proof of stake is about. It's about staking, having no costs to validate. It's about having a privilege other than doing some actual work to validate. So the work is, because the work is not on energy and hardware or installations or locations in the world, if the competition is not on that level, well, the competition will be at a different level because people are looking for earning money, right? This is why they become validators. So at what level is the competition taken to? So the competition is taken to the capital raising and speculatory level. So proof of stake can be used as a highly self-contained closed system that's governed and controlled by a small elite group that is constantly trying to build a permanent dominating position. So they are, once they get the largest share of the network, they'll just stake their money there and they have no incentives to take the money out of the network unless they find bigger returns, right? So in many proof-of-stake crypto systems, the yield is an invented number. It's an random invented number based on the designer's guess. That yield means absolutely nothing other than the richer becomes richer. It's just about that. It's just about the richer becoming richer. And because there aren't really any work after you stake, you pretty much have dominated the network. You have to convince other people to come in and invest in it. So proof of stake it's a closed system because my money, once I stake, I don't need to send it to any other places. It's very different from proof of work, in which a miner has to spend on facility, research, development, developing countries, far locations, and hire the cheapest labor, the cheapest labor that they can. So on proof of work consensus, what we have is truly a competition for hiring people all over the world to help generating that security. And as more and more miners come in, those low-cost labor will actually go up, because one miner will want to get some collaborators from another miner, and this is how it goes. This is just capitalism. Groups are fighting against each other to have those resources, to have most efficient resources than the other competitors. And as long as the market goes, any miner can be taken out of the game by a bigger miner. Let's say, for example, if governments start to buy mining facilities or creating huge energy generation centers only for mining Bitcoin, many miners will be taken out of the game. So this is pretty much what many people are forecasting, that governments will be fighting for being validators on proof of work consensus. So miners' rewards on proof of work depends heavily on their capacity to be highly efficient at using nature's resources. So it's pretty much expected that these people receive higher rewards than the other ones who aren't really being as efficient. So proof of work coins, on the other hand, they work as unspendable golden lottery tickets. You know that you will earn more because of that lottery, and they won't be spent. So the more lottery tickets you have, the more lottery tickets you earn, and the more value you will hold. It's pretty annoying from my point of view. So the best way to earn more than others in proof of stake is buying more unspendable lottery tickets. It is a closed system by nature. So even if designers are trying to create a very intelligent algorithm to kind of avoid double spending, what they are truly doing is creating a protocol that protects the highest stakers. And who will be the highest stakers other than powerful people, right? So have you ever heard about a lottery in which somebody could buy infinite lottery tickets month by month and just stack them, and they are never spent, and they are forever raising their chances of winning the lottery, the big prize, and they're earning more prizes as time goes by, in every month, in every week, in every day? This is what proof of stake is about. It's very, very weird from my point of view. So here we have the INJ token, injective protocol, which is an awesome protocol. They are doing synthetic assets trading. So the more INJ tokens you hold, the more you will receive when redistribution occur, as your wallet has a more significant weighted value. So they claim that this ensures this decentralized nature of the exchange. This phrase doesn't have any meaning. This makes no sense at all, because if the biggest stakers will earn the biggest rewards, how in heaven will this lead to decentralized money? It can't be decentralized money, right? So there are a tendency for wallets to concentrate more capital in the proof of stake protocols. So proof of stake usually attracts, this is another underlying message of proof of stake that I really don't like at all. And this states that proof of stake usually attracts high yield seekers who believe in the illusion of easy and free money. So this is the underlying assumption on proof of stake consensus. It's just free money. The biggest your stake, the more money you earn day by day, and you can get that earned money and stake again, and you'll never have to spend them. You just keep compounding forever and ever. But this is totally against economic nature, because all free things sold as valuable will be regarded as having zero value on the long term. So this is just fool's gold. And yeah, let's just keep going, because this gets me very excited, right? And really, if I'm wrong here, just shoot a message, just send me some things for me to educate myself. But this is the only thing that I have in mind right now. So proof of stake facilitates treasuring, and that means more concentration for capital. So more scarcity faster, and faster price rise. And this is another great thing in the market. When people see the price going sky high, they get interested and they buy the asset. But buying the asset after it went up is normally a bad decision. So, but this is what proof of stake allows and facilitates: more scarcity faster, faster price rise. But over the long term, it leads to less circulation, and therefore less demand and less value. If people keeps treasuring, the only way that they have to keep that money for being perceived as having value is by co-opting and convincing more buyers to pay a high price to holders. So this is what proof of stake is about. It's about co-opting more buyers, and it's about holders earning easy money. This is what it is. It's just a description of what happens. So let's see Anchor, which is a protocol. Anchor offers better yield. This is a basic message. Is there any better message than better yield in a protocol? So Anchor yields stable and attractive, powered by staking returns from multiple proof of stake blockchains. So they're promising here better yield for you who believes in stable and attractive yield. Come with us. So Anchor is kind of blatant and open about the yield seekers. But remember, the yield seekers are going after a percentage that was invented by a programmer. In bottom line, it's just a random number in the head of a programmer, so it doesn't mean anything. So if you don't read the underlying system, you just think that this is a very attractive copywriting. It's a very attractive message for people who don't understand the implications of proof of stake and no effort yield coming to the crypto space. So another thing that Anchor is providing is it is encouraging different proof of stake blockchains to compete against each other in the yield number. So that damn percentage. So what happens is the yield seekers will keep looking for higher yields with less effort. This is what there is, right? If somebody believes in high yield and easy free money, they will flock into proof of stake blockchains, and they will start to get the blockchains to compete to one another. And guess what? It will attract the vampire attack, which is a new blockchain coming over and promising a higher yield than the previous blockchain. So today in DeFi, we have so many staking pools with random big numbers. Where are those programmers taking those yields? They're mostly taking from their own heads, right? So it's just an invented yield. It's just an invented number on somebody's mind. It's just a base assumption of the design. There's no effort involved other than protecting the network from double spending and from cheating. The designers for proof of stake protocols, they are really thriving on protecting the biggest stakers, and the idea that the money will be free for the stakers, and the wrong thing is to assume that it will be more decentralized because of that. It's quite the opposite. The first ones who gets the more shares, the more lottery tickets, they will get the biggest returns, right? So yeah, Inch Protocol, proof of stake, treasuring, anchor. So let's go to the next one. In the long term, high yield seekers will always look for higher stable yields, threatening to abandon the network if their higher yields desires aren't met. So if I don't have enough money coming from a network, I'll just jump to the next one because I believe in easy, stable yields that are higher than the competitors. And this is a direct threat to the value stored in the network. Because when I like proof of stake protocols, what I'm telling the designers is, if you don't get me a good yield from this pool, then I'll jump to the next one and I'll not validate your transactions. So this is what I call the lion's dinner paradox. You are getting a big chunk of meat, fresh meat to the lion, and you are telling the lion by the morning, lion, please stop anyone who tries to eat that steak, and don't eat it yourself, or else you won't earn a very, very small bite of that steak for dinner. So you're trying to convince the lion of spending the whole day looking at the fresh meat and promising that if they don't eat the meat, they will earn a small bite by the end of the day. It won't work. It won't work at all. So yeah, pretty messed up. Proof of stake is very, very messed up because it's invented money. In proof of stake, bankers are the biggest players and also the owners of the casino, because imagine that if I can validate the transactions and also be the biggest holder, you are mixing two different roles together, and it's just not beneficial to the whole community. The bankers are the people who will actually be able to get the biggest share of the network. So it just works that way. It's very weird because you got some lottery tickets that issue stable yields every time, invented percentages from programmers' heads, and now they've got those tickets and they're also allowing the transactions to be validated. So they are being at the same time the owners of the casinos and also the biggest players. You, as a normal average guy, have no chance against the biggest stakers in proof of stake networks. So proof of stakes protocols can be misused as entitlement-based currency, especially if you are convinced that they are the most modern designs for crypto today. So the proof of stake protocols can and will be misused as entitlement based currency. There's nowhere in the nature a single place in which an animal is entitled to something. We as human beings, as a live species in the planet, we have to go through effort for earning our rewards and surviving. So proof of stake is kind of introducing the underlying assumption that you are entitled to receive money when you stake your money to the pools with no effort. It might be posed as a promise to greatly reward people for doing basically nothing. It's just like what the government does. Guess what? I'd rather be with fiat because if proof of stake protocols are used like that, I would just enjoy using my fiat money, right? So entitlement based currency, it's bad for everybody involved. It's bad for the ecosystem. But we don't stop there. As ETH is going proof of stake, Ethereum is going proof of stake, the transaction rewards will belong to the biggest wallets now. Miners are being taken out of the game, and the biggest wallets will have a permanent privilege to become both the validators and to earn the biggest rewards. So lifetime passive earnings. This is the thing that is kind of being implied when networks go proof of stake. ADA and DOT are following on that. Do you think this could, at any means possible, become a conflict of interest from the biggest wallet owners? I totally bet on that. And this is why I don't buy DOT, I don't buy ADA, and I don't buy ETH. Because I cannot and will not provide validation for easier returns for the biggest wallets. I want people to screw those systems, frankly. Sorry for telling you that, but it's just not a good sound economic design. It doesn't add any decentralized nature to anything. So if you hate greedy miners, and some greedy miners exist, wait for when you meet the greedy stakers, because they don't have any extra costs. Don't give the greedy stakers any chance of owning your capital. Don't buy the expensive proof of stake coins. This is my recommendation, right? So here today we kind of changed this a little bit because Doge is kind of jumping all around. Doge is a fine coin in my opinion because it's proof of work. It's proof of work and have a nice inflationary design. It provides a very long-term and fast transactions and everything. So here we have many proof of stake coins on the top of the pyramid, on the top of the king of the jungle. These are the lions. So many proof of stake just jump higher and higher, and everybody's kind of people get really excited about those proof of stake coins going higher and higher, and they don't sell because they are expecting the coin to be even higher in the future. But this has limits, right? So proof of stake versus proof of work. Which system? These are some series of questions here for you. Proof of stake versus proof of work. Which system has a higher probability of creating a breakthrough in clean, renewable energy in developing poor countries? Which system, from everything that we've seen here so far, which one of those systems has the potential to create renewable energy sources developing poor countries decentralize the cryptocurrency space. Which one is the best one? So who are the most capable of taking staking pools over? If you like the design of proof of stake and you are aiming at becoming one of the biggest holders over time, who are the most capable of taking the staking pools over? You or the bankers? You or the biggest funds? So let's go back to injective protocol. They've invented all kinds of percentages here. They've got baseline APY of 3%. They take this from their heads. They get claim reward, they get proposed mark rewards, they get redelegate reward, they get governance reward, proposed marks, and even the epic reward. What the hell is an epic reward? And why is it 3%? Why is proposed market successfully reward a 5% reward on my staking activity? And why this all add up to 17%? What is the economy behind those numbers? What is the rationale behind those numbers? It doesn't have, let me tell you the bad news. It's just random numbers from the developers' heads. So let's see another. Oh man, I laugh a lot about these random high numbers. Ethereum, 854%. PancakeSwap, earn up to 99% a year because we like that number, that percentage. BNB, 20%. Guess what? It will continue climbing. And then we have an example here of who are the biggest takers. This is the Equinox staking pool. They are introducing an entirely new model of incentivized staking, with both validators and delegators can participate, provide unique venues and everything. But then, in order to become a validator on Injective, you gotta be invited. Who do you think are being approved on this invitation? They will be in touch with you if you trigger some interest in them. So who are being approved as validators in the first stages? Do you think you have any chance against big funds? Well, I don't have. So let's see here, Injective also. Staked operates the most secure, high-yielding, and cost-effective blockchain nodes for decentralized proof-of-stake protocols on behalf of institutional investors. It's pretty blatant here. Institutional investors are our target. It's supporting leading POS-based projects such as Kusama, Audius, Mina, Synthetics, and Solana. So many famous projects here. All of them skyrocketed in value because the stakers don't have to spend any tokens, right? They can treasure and just buy more and more and just set and forget. So they are calling this an entirely new way for investors to earn returns. It is not entirely new way because those kinds of invented yields, there are many other events in histories that people tried to invent those kinds of things. It's just random numbers decided by central hive minds that believe they can control the economy, and they can't. Those high staking nodes, those higher yield returns, they amount to nothing actually. This is just fool's gold, in my opinion. So Staked's 3-year track record providing reliable validators across 45 proof-of-stake networks and over 4 billion in staked value. It's ample demonstration of its dedication to delegators, institutions, over and over. So this is what proof-of-stake is about. It is about institutions coming in, trying to get a big stake, set and forget money. I believe that many of these institutions can't reason behind the absurdity, which is the current invented yield returns from the networks. So they are going to, pretty much many of them are going to get wrecked, in my opinion, because invented money will have zero value in the future. So which currency will be the most valuable in the future? The free, effortless, politics-based money, or sweat 100% hustle money? So which currency will be the most valuable in the future? This is a very good question. Powerful groups will try to make proof of work seems like a waste of resources. Don't buy that. Don't buy that. I don't believe that all of them are being like evil or they want to scam people. I think many of the people who are investing in proof of stake are just naive. They are just naive. Proof of work provides an environment in which money has to flow. And as money are flowing, more people are depending on and getting in touch with that money as time goes by. And as more money is getting in touch with those coins, they are having a greater network effect. So proof of work coins are more slow at first, but they are circulating by the sheer force of the protocol itself. It's a fight against nature. It's a competition on math challenges and energy and being efficient. It's grassroots nature problem solving. So proof of work tends to be slower at the beginning because the miners have to sell and we got all of that. But later on, as more people get in touch with that cryptocurrency, many people will actually decide to keep trading and buying and using that cryptocurrency. So this is my theory. It's just a theory and a feeling right now. But I'm really convinced that proof of work will circulate more and more across the globe. And proof of stake really, it just makes people believe they can't enter at some point. I've seen many people selling all their Cardano for buying, for example, Nervos coins because they are so cheap. And I've seen people not going to buy ADA right now because they are telling it's just too expensive. There are more coins with a smaller market cap. And the truth of the matter is market cap doesn't mean that much when we've got high yields and encouragement to treasuring on proof of stake networks. There are many proof of stake pools all over. So I will avoid buy most of the proof of stake coins in the future and throughout my life. So proof of work, they get more profits from miners and it attracts more miners in the game and it attracts more demands for ASICs, which are the specialized hardware, and it attracts more profits for ASICs sellers, and it will attract more ASICs manufacturers. So it will attract more money to the industry as a whole. As more people get in touch with proof of work, there's a whole ecosystem being developed and money is flowing throughout the industry and different countries, even the developing countries. So it gets to a point in which there are more efficiency and more, it's really a gold rush for clean energy and more fast computation. It's a great deal of contribution for a green planet and for a sustainable planet. So it leads to systemic wealth distribution. It's really about the world as a whole. It's a holistic system. Every proof of work system is a holistic system. It kind of aggregates people from all over the planet and get those energy money flowing all around the globe. So proof of stake can't and won't have the same effect as proof of work, right? So since proof of work coins cost much more to be produced than easy, comfortable, high yield proof of stake money, these are the scarcest assets. When people are telling that proof of stake will win in the long run, they're just disregarding the fact that they can't ban proof of work. Proof of stake systems can't ban proof of work systems because every one of these systems, they are censorship resistant. So when we look at the two systems, proof of work and proof of stake, in proof of stake, the fight is really for who can raise the more capital and trade the hell out of the coins so that they can get the biggest share for getting the stable returns. And proof of work is about a competition on real world math problems and being a hell out of efficient. So it's much more difficult to produce a coin using proof of work consensus than it is for producing proof of stake. It's becoming a validator is pretty simple, right? You don't have to be an Einstein to do that. So it's like the lazy money against the smart money. So the proof of work money has much more value and it's much more secure than the proof of stake money. It's really the turtle against the rabbit, because proof of work will just be slow at first, and proof of stake will be very fast because people keeps treasuring it. And yeah, those two systems, in those two systems, the rabbit doesn't end up winning the run, the competition, right? So yeah, this is how I like to think about proof of work and proof of stake. Proof of stake, arbitrary yield tends to form big bubbles, just like fiat inflation does. And more value tends to flow sustainably in the future to well-designed proof of work coins. Because the scarcest and more valuable asset will always win in the long term. So even if proof of stake coins sky high at the beginning, later on people will just look at the market and they will ask themselves, oh, let me see the smaller cap coins in coin market cap. So they'll always pour their money in the slower coins, and many of the slower coins are just proof of work, except for in this bull run we have Doge like skyrocketing like 14,000%, but Dogecoin has spent years going sideways, years and years going sideways. So the holders of Doge, they are very, very patient. So now everybody's talking about Doge. So yeah, but there are more factors coming in, right? Doge is like a meme, and people like to play with memes, and there are whales like pumping the game for Doge and everything. But my theory is that proof of work coins will have more sustainable value in the future. So right now, I can't think of a more inequality-inducing and self-destructing cryptocurrency model than proof of stake when used in the wrong way. So when proof of stake is wrong, because not all proof of stake protocols are wrong in my opinion, when proof of stake is wrong, it is wrong when the percentages and the yields comes from just whatever, from the crazy numbers in the programmer's head. So the guy's asking here on this Reddit, well, where do stake rewards come from? And then somebody answered, stake rewards come from a combination of new coins from the reserves and the transaction fees. So it's some crazy number, like 80 plus years till the reserves run out. So crazy number invented, no competition for, no effort for getting those stake returns. So it's just invented, effortless money, and this doesn't exist in the economy. You're going to get wrecked at some point. So beware when this happens. Beware to quit and to take your profits right on time, right? So in injective protocol, we've already talked about that. This is probably just a double slide. Many invented percentages and epic rewards, stuff like that. So just crazy yield percentages taken out of nowhere. So if it's no cost money, it is surely a scam, because the people won't have the same deal of chance to go in. So if it's no cost money, it's probably a scam. So when is proof of stake right? In my opinion, it is right when the yield comes from serving a real world demand. So for example, we have Uniswap, we have the we have the staking from the transactions between exchanges, right? So when we are exchanging money and you are being rewarded accordingly to how many people are exchanging the tokens from different networks. So when we have money coming in and out from those pairs that are being traded, you are just earning money out of the real demand for those coins, and you have the pool of risk, the impermanent losses, and all of that. So when a service is kind of when there's a service being charged from real world people and real demand is being driven, I'm aware that Cardano, they have in Cardano they have the transaction validations and stuff, but most of the yields are just random numbers. So you gotta take care and really understand where those percentages come from. Because here in a staking pool, if too many people decide to go in, this is key in good staking yields. If too many people decide to go in a staking pool for, let's say, liquidity mining, the yield is going to drop because everybody's sharing the same amount of the fees, right? So it's very important that you are competing for some kind of yield that's driven by current demand in that market. So it's kind of it's exactly a work of supply and demand. And if more people come with a supply of some pair here, and it will just go up, there will be more supply than demand, then the outcome yield will drop. And if there's less supply, the outcome yield is going to go up. So you gotta look for not for stable returns, because those are really invented money. It has no value at all. but look for places in which the supply and demand market dynamics are happening. So here is the lending pools. They are also driven by supply and demand. And when you're participating on the staking pool, on a lending pool, you're gonna get good APYs when the demand is so high and the supply is low. So the yields are up. And when the yields are up, more people go in and more supply comes in for the service, and then the yield goes down. So it follows a market dynamics, a free market dynamics. It's very important that the protocols you invest in have those dynamics built in. And it's not just this is crazy. These numbers are taken out of the programmer's head. They don't mean anything. If they don't mean anything, if those APYs are not backed by real world demand, you shouldn't be buying it. And injective protocol is a great idea. It's about creating synthetic assets and tokenizing real world assets, creating derivatives. But the validation of the network is just random numbers out of the programmer's head. So it's not real money at all. Take Bitcoin, for example. People would argue that Bitcoin comes from the programmer's head. So Satoshi decided that the Bitcoin block rewards will be 50 Bitcoins at one point, and will be half of that 4 years later and everything. But even if Satoshi designed a very arbitrary issuance of Bitcoin, the miners have to do an effort and compete against each other to fight for a part of those block rewards. So it's very different because you've got the market playing their part here. The Bitcoin network is just about mining, miners fighting against each other for that supply of new Bitcoins being assured and issued to the network. So lending pools are okay also. You got a stake in there and you receive accordingly to the demand. The yields are fluctuating over time. Maybe sometimes you will earn lots of money on a rare coin that suddenly has got a bump in demand, and in the other times you just have a lower APY because everybody and their mother is lending the same coin as you are lending, and they're in the same pool and everything. But let me drink some water here. So for basic cryptocurrency proof of work, for basic cryptocurrency, proof of work protects the value you hold from collusion. Because as miners have all those expenditures, the money has to flow to other people's hands. You're creating systemic wealth, and the basic proof of work concept is protecting the value because more and more people will get in touch with it, and the network effect will be in place, right? So CKB is a proof of work utility token. So yeah, CKB is all around proof of work, and the team, they have a strong conviction in proof of work as a proven protocol for handling cryptocurrencies, and they improve from Bitcoin's base consensus protocol. We're going to be talking a lot about that nitty-gritties in the future, but this is pretty much it for today, right? I think it's enough. So what proof of stake really stands for here after all this conversation? It's really about proof of stake or a proof of scam or a proof of mistake or a proof of I don't know. Maybe a proof of, yeah, I don't know, whatever. It's up to you for understand and interpret and think and reflect on that, right? It's up to you to say what it is or what it is not proof of stake protocols. So if you agree that proof of work consensus protocols are best, then you should hold your nervos, my friend. The CKB token you can buy on Binance, Huobi, Bithumb, Voyager, and GliaSwap is coming over. So, yeah, that's it. Come and chat with us. If you like this video, subscribe to this channel, press the like button, shoot your message, just shoot a comment in order to help this video to be bumped in the YouTube network, and come to chat with us. Come have a good time on the Nervos Network official Telegram channels, channel, and the Nervos unofficial channel, which is actually the most fun one, right? So Nervos Network official channel is just to directed into taking questions, answering questions from people who want to understand CKB technically and things like that. And Nervos Unofficial is the one in which we do kind of lots of good conversations, and yeah, the community itself is amazing. I bet you like it, right? So that's it. Bye bye.